Well, I may surprise you. We've just come through probably one of the best quarters that we've had in the last 6 quarters. And the reasons for it are that we look after families, period. Maybe a hospital, maybe a foundation, but by and large...
McGill's the family?
I don't look after McGill. I happen to be on the McGill board, and I'm proud to be on it, but I don't, in other words, we don't manage McGill or any part of McGill. But with the Canadian market down 13.5% to year to date, we were looking at some of the portfolios this morning from the end of November to the end of February. And as we have been down, as we've had cash reserves of, say, a balanced fund of 20 to 30% under the 50%, and that's where we stand. No Canadian banks for 3 years. No American banks for I can't tell you how long, and being very, very choosy, and having companies like Empire, Weston, and some of the others, which by the way have done well in this quarter. We're down. I looked at a whole series of accounts, somewhere between 1.5% and 2.5% for the quarter. I was looking at some of our friends' portfolios this morning to the end of January, and really I can see why people are nervous, and very nervous. So I was looking at some of our competitors, and we know who they are, and they're back to 1996 levels. It's been just a bloody bloodbath for them. The other thing that I've been interested in, and is what's happened in the oil patch in the last couple of days, where Alberta reverses the royalty regime. And I wonder to myself when it's going to be Mr. Flattery's turn to say, we're going to extend this out 2 or 3 years because, anyway, he wants to be reelected. Also, in the paper today, how the central bank changes tack on the credit crisis. And then I read this morning about, is the market bottom finally in sight? And then I go on to see what China is doing, and the Premier of China is supposed to be talking tonight as to what they are doing with the second tranche of the big stimulus plan. And my friends in China who've just come back from China have said that most of China is living in the Stone Age. They better act quickly or we've got revolution. Most people I talk to can't even, won't even look to the end of their nose. They want to find out what's going to happen tomorrow, so they invest in tomorrow. And these long-term investors, you don't find around today. We've been in business, the Heward firm, for 88 years. And we wouldn't be in business for 88 years if we just looked at the very, very short term. Where are we now? And it'll take me 5 minutes to read it. You had Maureen Farrell, who was one of our strategists, in last week, and she gave you the long L that nothing is going to happen really for the next 5 or 6 years. On the other hand, on the technical side, which sometimes I look at, not all the time, because with what all the hedge funds are doing, and you saw gold come down from 1,000 to 900 today. In other words, technical research doesn't tell you that. In my view, it's the hedge funds were dumping because they had loaded up in gold, and as the market started to pick up off today, they started to cover some of their positions, which some people say they're doing. But looking at the Notley notes, the Jonathan Archer notes today, and I looked at them for the first time. When I looked at the Canadian picture, short-term and long-term, I've never, ever seen this market as cheap it is right now. When you take a look at at not only the Canadian, but you take a look at the global top 350 stocks. Then I went to see what stocks are on the upturn, and very, very sharp upturn, in particularly in our country. And there's a list that long of an up phase. So what we have been doing, I only got this morning, we're saying the current economic and market environment that we find ourselves in continues to be very fragile. The fallout of the subprime mess and the financial crisis that ensued has dragged the economies of the developed world into recession. Governments all over the world are attempting to buy jobs through massive fiscal stimulus packages, while monetary policies have brought interest rates close to zero. After bursting every bubble, economies and markets always find themselves in long periods of negative or low returns. The bigger the bubble, the longer that period will be. As we currently find ourselves in such an environment, we are focusing on three key aspects in managing our portfolios that we expect will result in enhanced returns. First and foremost is asset allocation. A key part of our overall strategy has to be maintain large exposure to Canada, where the broad structure of the Canadian economy remains sound when compared to the fellow G7 nations. A second key component of our asset strategy over the last 2 quarters has been to underweight equities, and most of our portfolios currently find themselves 20 to 25% below benchmark in terms of exposure to equities. We are waiting for clearer and economic environment, to significantly market opportunities before we add or return to more normal equity allocations. Our next step calls for a more defensive while opportunistic within our equity allocations. We have reduced our exposure in industrial commodities, over the past 6 months, while increasing positions in sectors that are less likely to be significantly impacted by the current economic slowdown. Companies that have more visible earnings and potential dividend growth will be high on our list of stocks to buy. Our recent purchase of Shoppers Drug Mart is a perfect example. Furthermore, after years of avoiding the banking sector, we decided last week, and I mentioned it to you last Friday, to use current market weakness. Banks are down more than 50% from their highs to reestablish positions. With attractive valuations and yields of over 7%, some 6.5%, we've added both Toronto Dominion and Royal Bank to our holdings. The third step of our overall strategy is to enhance returns in the fixed income positions of our portfolios. This made even more important by the fact we are overweight in this area. While remaining relatively short in duration, recent purchases of high-quality corporate bonds provided yields in excess of 300 to 350 basis points over what was available from the government issues or bank deposits. Furthermore, we recently invested in several bank preferreds, particularly Royal and TD, which carried yields of 6.25%. Therefore, the dividend tax credit is applied. So you gross those up, and you see what happens. Very expensive reset terms in 5 years. We are confident that these issues will be redeemed by the banks at that time, by those 2 banks at that time. In an environment where the central bank has drastically reduced interest rates, these moves have allowed us to maintain income produced for your account, offsetting income lost by a number of bond maturities. Within the current volatility and certain market environment, preservation of capital remains a priority. We continue to believe in a broad diversification of our asset classes while maintaining a bottom-up approach to manage our portfolios. We do not allow an economist to tell us what to do.
Okay.
We remain confident in the long-term investment potential of many of our core holdings, as we feel they represent great long-term values. And we will continue to focus even more on defensive holdings, companies that are financially sound and have a potential for earnings and dividend increases. We prefer to remain conservative at this time and don't see the need to be adventurous. Now, we have a target on Royal Bank of $35 a share. We bought it at $27.5, $8. If we get the dividend, a couple of dividends, we have a 25% return. Oil prices going up.
Yes, sir.
And silver is not gold.
Okay.
Is the thing we're focusing on.
Okay.